So what is a buy-to-let mortgage? According to Investopedia, a mortgage is a type of loan used to purchase or maintain a home, land, or other types of properties. The borrower agrees to pay the lender over time, typically in a series of regular payments that are divided into principal and interest. The property then serves as collateral to secure the loan. Mortgages allow you to lower your initial deposit on the property, but also boost your returns. The higher the mortgage, the lower your down payment, the more you boost your returns, and the more you leverage. We will discuss the pros and cons of leveraging in our next video. So what are the differences between a buy-to-let mortgage and a standard residential mortgage? Well, first one is that typically for a buy-to-let mortgage, we use interest only. Buy-to-let mortgages are typically interest only, meaning that throughout the life of the loan, the borrower will only pay for the interest accrued and will not be paying the principal or the mortgage itself. The main advantage of interest only, and you may see that abbreviated as IO, is that monthly payments will be considerably lower. Therefore, you'll have positive cash flow much more positive cash flow from your investments, and borrow more, given how mortgage affordability is measured in the buy-to-let world. So, with a buy-to-let mortgage, how is affordability typically measured? In buy-to-let mortgages, affordability, which is the ability to borrow money, is based less on what the borrower earns and more on the rent that they can typically charge their tenants. Lenders typically want the rent to cover 120 up to about 140, 145% of the mortgage repayment. This number is called the ICR, and that stands for the interest cover ratio, or coverage for short. Thinking about a deposit, in buy-to-let, lenders will typically ask the borrower to advance or to deposit 25% of the property value, sometimes even more. This is massive when compared to residential mortgages, where schemes such as Help to Buy are allowing homeowners to only put down a 5% deposit. Because of how different buy-to-let mortgages are to residential mortgages, the buy-to-let mortgage space is much more reliant on specialist lenders.